Can gold hit $50,000 an ounce by 2022? Luke Gromen says yes. I'm going to explain this to you in 3 simple, fast steps. Step number 1, let's go over how the government is insolvent, something most of you probably already know, and what they can do as a solution that would give them the options in the future to raise interest rates if inflation gets out of hand. It would also increase nominal GDP and do a lot of other things the central planners like your drunk, insolvent Uncle Sam want to achieve. So let's start by going over what are we dealing with here when it comes to how much the federal government owes. Editor, let's throw up the debt clock. The on-balance sheet debt, around $28 trillion. But this doesn't include unfunded liabilities. So when you throw that in the mix and look at the liabilities the government has that are off-balance sheet, we're closer to $150 trillion. I also want to point out a good portion of the government's $28 trillion in on-balance sheet debt matures in the next year. It's very short term. So every year, let's say the government has to roll over $10 trillion. I had to find where it was on the whiteboard. And this $10 trillion is a rough estimate from Luke Gromen. But the point is the government is very sensitive to interest rates. Right now, the average rate they pay on the debt is maybe 2%, a little less. So you can imagine what would happen if they had to roll over $10 trillion over the next year at a much higher interest rate, say 6%, 7%, 8%. It would completely crush the federal government. I think the best way to think about this is your drunk, insolvent Uncle Sam has the largest adjustable rate mortgage in human history. So the bottom line is they need the debt to GDP to go down. Currently, it's about 130%. So what could be one of the solutions? Well, oddly enough, it comes from everyone's favorite economist, Paul Krugman. He is sitting here. He says, "Oh, I know, George, don't worry about this. I've got some ideas that will solve this problem instantly." Check this out. So what Krugman suggests is the government leverage the U.S. Mint. That's right. The entity or the building, the group that actually creates the gold and silver coins. Now, what's interesting about the Mint is they can only produce gold and silver coins with certain face values. I think the maximum might be $50. But there is a loophole for platinum. So the Mint could theoretically create a platinum coin, let's say worth $11 trillion, or with a face value of $11 trillion. And they could just sell that to the Federal Reserve. And then the Federal Reserve would credit their account with, let's say, $11 trillion. And then the government would have the funds they need to increase GDP or to pay off debt to solve those problems of being insolvent in the first place. And I'm sure a lot of you watching this video right now have heard of Krugman talk about creating a $1 trillion platinum coin. So let's back up a little bit so we all understand how this works. We got the Federal Reserve and the government. Like we said earlier, your drunk, insolvent Uncle Sam is right there, and he has got big problems. $28 trillion in on-balance sheet debt. So that would be a liability. We've got the balance sheet of the government here. We've got the balance sheet of the Fed right here. Assets on the left, liabilities on the right. So the liability on the right-hand side of your drunk, insolvent Uncle Sam's balance sheet, $28 trillion. Some of the assets, though, that would allow them to create this $11 trillion platinum coin And don't worry, guys, we're going to take this back to gold. This all applies to how gold gets to $50,000. I haven't gone off on an extreme tangent yet. So some of the assets the government has, it allows them to enforce the face value of this $11 trillion coin. They've got guns. They've got tanks. We all know the rest of the story. So on the Fed's balance sheet, they have the government's checking account. It's a liability of the Fed. It's called the TGA, the Treasury General Account. So right now, let's say the government's checking account has around $1 trillion. Well, the mint could just create this $11 trillion coin. Like we said earlier, that goes right on to the asset side of the Fed's balance sheet. And to pay for this, they create funny money, bank reserves, fugazis out of thin air.
Fugazi, it's a wazi, it's a woozy, it's a fairy dust. It doesn't exist. It's never landed. It is no matter. It's not on the elemental chart.
And put them into the TGA. So now the Treasury General Account has $12 trillion instead of the $1 trillion it had to begin with. In other words, it has an additional $11 trillion worth of purchasing power that it can use to either pay down debt or spend into the economy, with the idea of increasing GDP, which would bring that debt to GDP ratio down from, let's say, 130% to 75%. And it would allow not only Janet Yellen to try to stoke the economy, but if they needed to raise rates to fight inflation or to defend the dollar, Jerome Powell would have the ability to raise the federal funds rate without bankrupting the government. Now that you understand this, let's talk about how Luke Gromen thinks gold could go to $50,000 an ounce. Step number 2. Now it's time to revalue gold much, much higher. And this is an idea straight from my good buddy Luke Gromen himself, which is very similar actually to the $1 trillion coin idea that Krugman had. I don't know if it was actually his idea, but it was one that he endorsed. To understand this further, let's go right to a recent interview with Luke Gromen and Ed Harrison on Real Vision.
The U.S. fiscally is in an irrecoverable position. This Soros, Druckenmiller playbook, we ran it in the early 80s. Volcker did. We defended the dollar, took rates up, put us into double severe recession. The challenge is that they can't raise rates in any real way, to your point earlier, without making it worse, because the debt to GDP is so high. And so the first thing you need to do to fix the situation is get the debt to GDP down to a level where you can significantly raise rates without breaking the system. And the reality is that was sort of the playbook discussed post 08. Well, we'll just grow out of it. Well, we didn't. We're sitting here at 130% now. We were at 80% back then and going higher. So you need to get the debt to GDP down really fast. And there is a point a portion that was pointed out to me in the Federal Reserve Bank operating manual. It says that it's right there in black and white. If the Treasury tells the Fed to revalue the gold higher, the revaluation amount gets put into the Treasury General Account, or TGA. And the TGA, they can spend however they want. It's just an accounting creation. It's gimmicky. It's wonkish. It's no different than Paul Krugman recommending the $1 trillion platinum coin, except with gold. So he used platinum, but it's the same damn thing. So the challenge is our debt's so high, you'd have to revalue gold enormously. It's basically $4,000. Every $4,000 on gold is $1 trillion into the TGA, right? So if you took gold to $50,000 an ounce, as incredible as that sounds, you would be putting $12 trillion, give or take, into the TGA. And then you could you could build infrastructure, you could build education, you could do all these things that would take GDP up enormously over the next several years. And at the end of that, not even over the next several years, a year from now, debt to GDP could be 60, 65%. And now the Fed can normalize rates after this de facto significant devaluation of the dollar. And so it's really the only way out at this point, in my view.
So here's how it would work. We start off with the same players. We've got the Fed, the government, your drunk, insolvent Uncle Sam, two balance sheets, assets on the left, liabilities on the right. But this time, instead of minting that $11 trillion platinum coin, the Treasury actually owns about 260 million ounces of gold. So what Luke is saying is that the Federal Reserve could go ahead and buy the gold that the Treasury has at, let's say, Fort Knox or wherever they're actually storing it. Who knows? That's a topic for a different video. Or they might not buy the actual physical gold, but they would buy gold certificates that wouldn't be redeemable. My good friend Lynn Alden has thought this through, and we had a discussion back and forth on Twitter just yesterday. So let's assume that the Treasury still holds on to the 260 million in physical ounces of gold, but sells the Fed gold certificates. Well, remember, the TGA started with $1 trillion, and our objective is to get it up to $11 trillion. This is the bank account of the government or the Treasury held at the Fed. So in order to do that, the Fed would have to buy $11 trillion worth of gold certificates. Well, if you do the math, 260 million ounces of gold at, let's say, $2,000 an ounce is nowhere near $11 trillion. So the Fed would have to buy those ounces of gold from the Treasury at a much, much higher price. I did the back of the envelope math, and it would be right around $46,000 per ounce, which is why Gromen says gold could be revalued up to $50,000. Now, I know most of you are probably asking the question right now, okay, I understand how this is working, but it's a transaction pretty much between the Fed and the government. So how would this apply to me and the value of the gold I own? In other words, how would this apply to the actual gold market? Well, I went back and forth with Luke yesterday via email, and his idea is they would either buy those gold certificates or buy the physical gold, and then to justify the price they paid, the Fed might go into the gold market and actually buy more physical gold that they would have on their balance sheet to add to the $11 trillion of gold certificates to not only justify this price, but to make sure they didn't have negative equity. Now, who knows? The Fed might be able to have negative equity, not be insolvent, because they can print funny money. They can create bank reserves out of nowhere. But let's assume for a moment they actually have to abide by GAAP, generally accepted accounting principles, for nothing more than just this smoke and mirrors game that they're always playing with expectations policy and having to convince the average Joe and Jane that they've got everything under control. Another way they could justify a $46,000 an ounce price they would pay for the Treasury's gold, or a claim on the Treasury's gold, would be to go into the gold market in advance and buy enough gold to drive up the price to $46,000 or something close to that. Then they would have a lot of gold on their balance sheet. The market price would be close to $50,000. So then the Fed could go to the Treasury and say, okay, now we'll go ahead and buy a claim on that gold for, call it $46,000 or $50,000 per ounce. It's pretty much the exact same thing, but in reverse order. Going back to the clip with Luke, what he sees the government doing after they had, let's say, $12 trillion in the TGA, an additional $11 trillion from this gold transaction, is taking the $11 trillion and spending it into the real economy. This would boost nominal, notice I said nominal, GDP. More on that in step number 3. This would boost nominal GDP through, let's say, infrastructure spending, which would take the debt to GDP from 130% down to, let's say, its target range around 75%, and it would give Jerome Powell the tools he needed to combat inflation, defend the dollar, like we talked about in step number 1. Additionally, it would give your drunk, insolvent Uncle Sam the ability to spend all of that money into the real economy on infrastructure spending, stimmy checks, you name it. Bottom line, to buy more votes. So the politicians obviously would love this idea from Paul Krugman or from Luke Gromen. And I need to apologize. Luke, I'm sorry for comparing you to Krugman. And I'm also sorry for always drawing you looking like an NPC meme, but I can't do any better than that. So the main takeaway from step number 2 is the Treasury basically sells the gold to the Fed at $46,000 an ounce, call it. They get an extra $11 trillion in the TGA that they can pay down the debt. They can increase nominal GDP. And the Fed has an additional $11 trillion in, call it, gold certificates as an asset on their balance sheet. Now, I know some of you right now are probably saying to yourself, wow, George, I've seen you do a lot of whiteboard videos, and that was probably the simplest one I have ever seen. Oh, but wait, there is more. This is where a very simple story takes a complicated, unexpected turn. Step number 3. Now let's talk about some of the unintended consequences. In steps 1 and 2, I revealed how the Fed could revalue gold up to $50,000 an ounce, something that I'm sure makes a lot of you pretty excited, at least those of you that own gold. But as you know from watching my videos, there is no free lunch. Let's dive into it further. First, we have to remember that inflation is usually a result of the amount of dollars relative to stuff in the real economy going up. So the amount of dollars or currency units circulating in the real economy goes up, or the amount of stuff goes down, or a combination of the two, which is what we're seeing right now in 2021, where the amount of dollars going into the back pockets of the average Joe is increasing, while the amount of stuff the average Joe and Jane are producing going down significantly. And what happens as a result? The price of the stuff you buy on a daily basis continues to go up. Also, let's remember what the yield curve looks like. So right here, we've got 1 month, 3 month, 1 year, the 10-year, the 30-year. On the left, we go from 0% interest rates up to 2%. So if you look at the yield curve today or within this week, the one that I looked at, the 1 month T-bill is paying you a whopping 1 basis point. 1 basis point to own it. So it's basically 0. The 3 month, 2 basis points. You go all the way out to a year, and it's only paying you 6 basis points. But what happens when we go out to 10 years? All of a sudden, that curve gets really steep, and the 10 years paying you 1.59, and the 30-year roughly 2.25%. So you see two completely different trajectories. And this goes back to something that Alden always talks about, and that when you look at treasuries, you have to compartmentalize them. The short end of the yield curve is usually used for collateral in the repo market, which you guys know from watching my videos. But when you look at the long end of the yield curve, it usually behaves more like traditional bonds, what we would think of the government issuing debt. So why is this a big deal? Let's think this through. If the government mints a $11 trillion platinum coin, or if they revalue gold. So the Fed puts an extra 11 trillion into the TGA, Treasury General Account, which is the Treasury's account, bank account, checking account that's held at the Federal Reserve. That means the outstanding on-balance sheet debt, call it roughly 28 trillion, would come down to about $17 trillion. But let's think through this one step further. If the amount of debt the government owes, or the amount of treasuries in the system goes down by $11 trillion, that means there's $11 trillion less collateral for the repo market. But let's go back to this yield curve. What is it telling us? It's telling us that on the collateral side of the yield curve, there is tremendous demand for T-bills, for these treasuries that mature within 1 year. And it stays very flat even going out to 2 years. So what would happen to the demand-supply balance if we just took out $11 trillion worth of this collateral? The entire repo market would collapse. These rates would go down to negative 3, 4, 5%. Who knows? While these rates would most likely even go higher. So you would get these wild distortions and volatility in the monetary system, in the dollar funding markets, as a result of the government paying down their debt. In other words, taking that collateral out of the system. And it's really important we understand this. So at the risk of being redundant, let me explain it a little bit different way. You've got the Fed, and you've got the primary dealer banks. We'll call them A, B, and C, or the banks under the Fed's umbrella. Transacting in the repo market, you also have hedge funds and financial institutions. This is the plumbing of the global monetary system. So right now, let's say there's $28 trillion worth of treasuries going back and forth with all of these entities, or that they have access to create the liquidity they need to really stay in business and fund global economic growth or global economic activity. What happens if there's not enough collateral in the system? Well, what happened to Lehman Brothers? What happened during the GFC 2008 when everything started to collapse? That was a result of not enough pristine collateral in the system. So if we were on the brink of a financial meltdown as a result of not enough collateral in the system, what would happen today if we took out $11 trillion? It would be something far, far worse than what we saw during the GFC. It would be completely unimaginable. The whole house of cards would come tumbling down. So now some of you may be saying, okay, George, yeah, I get what you're saying, but the government doesn't necessarily have to pay down the debt immediately with that extra $11 trillion. To Luke's point, they could go ahead and spend it on infrastructure spending to increase nominal GDP. And I totally agree with Luke, for sure. But the devil's in the details. There's some more problems with that as well. See, what happens when the government spends to increase GDP is, yes, they might get more revenue, but they also increase the cost of their expenses. And Luke has mentioned this several times when he talks about the unfunded liabilities such as Medicare and Medicaid. It's not really a price we're paying or what we've promised. What we've promised is the actual service at any price. So just because in today's dollars we owe, let's say, $100 trillion in unfunded Medicare and Medicaid costs, well, in the future, it doesn't stay at 100 trillion. It could go up to 300 trillion. Who knows how high it could get It all depends on the rate of inflation and the cost, the price of goods and services. Let me give an example on the whiteboard, hopefully makes it a little more clear. We've got the revenue and the expenses of the government. This equals the deficit or surplus, which goes into the debt to GDP. Pretty straightforward. Currently, let's say the revenue is at $3 trillion, expenses $7 trillion. This gives us a deficit of $4 trillion. And we've got the debt on balance sheet around 28 trillion. GDP, we'll call it 22. This is what gives us that 130 roughly percent debt to GDP. Well, what happens if the government spends that $11 trillion into the economy and GDP doubles as a result? Maybe we get a little bit of a multiplier effect. Who knows? Well, what would happen, especially if we're not creating any more stuff, which I doubt we would be because the government's spending it. So by definition, it's creating distortions, malinvestment, and a misallocation of resources. But let's say we had inflation go up to the same degree. So 100%, prices just adjusted higher. Well, the revenue going to the government would double. So now they'd have 6 trillion coming in. And you say, well, that's fantastic. That solves all the problems right there. Not so fast, because the expenses go up to 14 trillion. That would give us a deficit of 8 trillion, twice what we had before, but it does decrease the debt to GDP ratio. It takes us to 36 trillion in debt and 44 trillion in GDP, which gives us about an 80% debt to GDP ratio, much lower. But let's think this through. This is really the key to the equation. Because if we've increased the deficit to 8 trillion and we don't spend another $11 trillion, let's say platinum coin, we don't have that goose that continues to lay the golden egg, in 2 years, our debt to GDP ratio would pretty much be right back at 130% where we started. So although it would allow us to kick the can down the road even further, it isn't a permanent solution. And oh, but wait, there is more. Let's think about what happens when the government pays down debt. Maybe they don't do it all at one time, but they just kind of do it gradually. So as the debt rolls over, then they pay it kind of year by year, and it's just not all at once. Okay, fine. Well, what happens to the money supply? The amount of dollars if the government does not roll over the debt? Let me explain. Right now, when the government rolls over the debt, meaning they just borrow $1 trillion to pay the bondholders $1 trillion they owe them. What they're doing is they're borrowing $1 trillion, so taking $1 trillion out of the system to go ahead and put that $1 trillion back into the system by paying the existing bondholders. So as far as the amount of currency units in the real economy, it's a wash. Because to pay this guy to create more currency units, they're taking currency units out of the system by selling more bonds to this guy in the first place. But what happens if you don't sell bonds to pay off the existing bonds that are maturing? Well, it's pretty simple. Believe it or not, I do have an eraser as well as these whiteboard pens. So we'll go ahead and erase this guy. And it gives you a very simple illustration of what would happen. Now, instead of taking the dollars out of the system, all they're doing is putting dollars into the system, which increases the amount of dollars chasing goods and services, which most likely would create higher price inflation. But remember, what was the point of lowering the debt to GDP in the first place? It's to give them a tool to actually fight inflation. So although they may have an additional tool to fight inflation, they would be creating even more inflation by giving themselves the tool to fight inflation in the first place. So the whole point is by revaluing gold up to $50,000 an ounce. It is a very simple, clever, kind of wonky solution to lower the debt to GDP ratio. And it might make a lot of you watching this video extremely rich. But at the end of the day, it's far from a panacea. And we all have to remember there is no free lunch. The only way that we can get rich is by increasing our productivity and creating more goods and services. It's never going to come through financial engineering. For more content that'll help you build wealth and thrive in a world of out-of-control central banks and big governments, check out this playlist right here, and I will see you on the next video.